Hey traders, Richard K here from Price Action and Income, and in today's video I want to talk about the topic of trends. I get asked quite often how I define trends. There are obviously some basics that any trader should know. I'll go over those first, but I use certain tools, if I can say that helps me define trends better. I'll be showing you these tools as well as also how I decide to get in a trend. As you all know, or should know, the trend is your friend. It's a very, very famous saying out there in the trading world. But in the end, knowing where to get into a trend without getting stopped out and avoiding a sudden reversal, etc., is the challenging part, obviously, in trading. So without further ado, let me just go over some basics of trends. As you all know, and I'm going to be using the Euro-US dollar on a daily time frame. Trends can obviously appear on any time frame, depending on what your trading style might be. If you're a scalper, you might be looking at a 5-minute chart. So, although in my opinion that could be quite noisy, it really depends on how you want to trade. Trends obviously appear on any time frame. So, I quite like more of a swing trading type of style, trying to go for large swings in the markets. So I tend to look at daily time frames, weekly time frames, and then I'll also zoom into smaller time frames like a 4-hourly or even a 30 or 20 minute to decide where I should enter. But anyway, without further ado, I'm going to use these examples of these bullish moves in the Euros dollar, especially this 21 in 2017 to the upside, and this one that started in March this year to the upside. And I'll be showing you these tools that I use to define these trends, which are really, really cool to use. First off, as you all might know, what defines a trend? And the basics would tell you whenever you learn or start learning about trading and price structure, etc., is that in this case, in an uptrending market, a trend is defined by a market. In this case, it goes higher and it creates a higher high. Price then comes lower, it creates a higher low, and then goes higher, lower, higher, lower, higher, lower. But all these declines that happen after a higher high, for example, does not break, for example, the previous higher low. So it's sort of like a stair-stepping movement to the upside. So uptrends are basically defined by higher highs, higher lows, higher highs, higher lows until things change and you get a reversal. Similarly to uptrends, obviously just the opposite way around. If you have a downtrend, downtrends are defined by, in this case, you have a high, price moves low, you have what we call a lower low. Lower high, lower low, lower high, lower low, lower high, and so forth. And that defines a downtrend. So one of the most basic tools that you've probably been taught to use is a trend line. And that's obviously why it's called a trend line. In this case, in an upward moving trend, although this is in hindsight, a trend line will generally be drawn from an origin point, and some people might say you need at least 2 points that you want to connect to. So first point, second point, third point. And once those lines are broken, you, in many cases, will have a trend reversal. But here's the other thing. As you all know, that trends tend to get steeper and steeper in angle like I did over here. So if first you had this angle over here, high, 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 low, and then price all of a sudden starts shooting to the upside. And this is why it's very important to adjust your trend lines. They should not just be there and keep them there. I truly believe that you need to keep on updating as the market evolves. So that will be quite often what you'll see on a strong move to the upside. Again, at least trying to, from your origin point, connect your trend line, in this case, again, an uptrend, to at least 2 or 3 higher lows in this case. And then when price actually broke this, yes, we got a correction. Now, this is where a lot of traders might actually fall off the bus, if I can say that. They'll quite often think, especially when you're a beginner trader, that once a trend line is broken, it signals a change in trend. So that's why it's very important to have additional techniques. And one of them I'm going to show you now is market geometry. And another one I also incorporate in my trading is Elliott wave, which I apply loosely to the markets. And what I call by loosely is that I like to count waves, and there's a saying in the market that if you put two electricians in a room, that both of them will come up with different analysis, which is completely true. This is why I use market geometry with combination of Elliott wave to help me figure out where I am within a trend. So after this line was broken, this was actually just a correction. I'm going to showing you how this correction or end of this correction could have been figured out, where it might get or might stop before the next trend goes up. And when price actually breaks or broke above this high again, you can then just connect another trend line. Now what's really cool about Elliott wave, and let me just get my counting tool out here, is that you'll have a trend that runs in 5 waves. 1, 2, then you'll have an impulsive third wave. This is I'm doing in hindsight, guys. Obviously doing this in real time is extremely difficult, but it can help you if you loosely apply it, like I'm going to show you now with my market geometry, to help you figure out where you are within a trend. So yeah, trend lines do have their place. They are important to use, but like I mentioned before, by the time price actually broke this line that we drew back here, let me just bring that back, you know, you could have missed quite a large move already. That's why it's very important to continuously update your trend lines. Okay, so this brings me to my favorite analysis technique, which is market geometry. Now, I can talk about market geometry all day long, but my most important tool that I use is the pitchfork. Now, I've made previous videos about pitchforks, so you might want to go have a look at them, just to figure out if you're unfamiliar with the pitchfork of what all these lines and so forth mean. But just for this video, I'm going to be showing you what I use to define trends, but more importantly also corrections. Now first off, I'm using TradingView here. You might be using MetaTrader, NinjaTrader, whatever your platform might be, but in any case, if we'll start with a standard pitchfork, you need to select 3 pivots or anchor points on the chart. So there was obviously the origin of this move to the upside. If you then go to your first higher high, just find that properly. Oops. Sorry guys, let me just delete that and zoom into this a little bit more. Here we go. So you want to select your first anchor point. You need 3, like I mentioned before, to use a pitchfork. You want to go from the origin to your first higher high, and then to your higher or higher low in this case. And you'll often get told by other traders that your standard pitchfork setting, and I'm going to quickly switch it between this so you can see the difference here. That's your original Andrew shift pitchfork, or sorry, standard pitchfork as they would call it. And by just changing that setting, you can see that it's angled very strongly to the upside, in this case working with a bullish trend. And for me, yes, there's probably some use in this by figuring out that price couldn't break through what we call this lower median line here, but what I quite like to do is it didn't really define this move to the upside. Okay, so there are other settings, and these are the majority of the settings, or the settings I use the most, which is secondly the shift pitchfork. Now, a shift pitchfork, as soon as you've seen that I've changed that setting, it's actually angled or sloped at a flatter or not as steep as your standard pitchfork. Okay, so immediately by just switching that, although price went out of the boundaries of this setting, you'll see that while price was moving up into these highs, that it started respecting what we call a low median line, a center median line, and an up median line. Now I also have these guidelines, which I call 50% dash median lines, which are great to use if you want to spot that you actually, or figure out if you're actually using the right setting. Okay. So now, although price left the boundaries of this pitchfork, what I like to do is I copy and paste those same angles and attach it to the top side. we can just do that if you wanted to. So same angle and slope, just copy and paste it and add it to the top side there. And immediately you can see by just using those first 3 anchor points that price continuously respected these lines. You can look at them up and down, and found support and resistance at those lines all the way to the upside, and even until we actually met these highs. It did overshoot those highs, but it failed to actually stay above them. Now, in combination with some Elliott wave, we could then say 1, 2, 3, 4, 5, maybe then start expecting a change in trend. Another tool that you can use is channel lines. And very simply, if we use the same anchor points that we did before, and we do that, and I copy and paste them, and continuously add them to the upside, then you'll see that the market also stayed within confines of this. It nearly reached the upper channel line here before that correction or move to the downside started. So this is where you can start playing around, because with market geometry you need to continuously think about what the market is doing. Using this anchor point and going to there, actually incorporate this one and that low there as well. Now let's copy and paste that to the upside. And you might say there might be a lot of lines that's on your chart. I tend to keep 2 different charts. One with a lot of lines on them and one with fewer lines, so I don't get confused of what I'm doing when I'm trying to trade, and just always keep note of where those lines are. Now look what happened when you doubled up this 2 times to the upside. This gave us the exact high over there. Again, this one was done in hindsight, but this is typically what I'll be doing. I'll have these lines on a larger time frame chart, and they help me to figure out where price might be moving, and then also seeing support and resistance, not as a horizontal line like most traders would, but also more at an angular sort of function rather than a horizontal one. Okay, so something quick, cool I want to show you here. If we go here to there, and we switch back to, what was it, the shift pitchfork that I used before. There we go. Then you'll see that price very nearly touched that upper red warning line here before it moved to the upside. And this is where I tend to start looking at corrections and focus more on corrections than I would on trends, because what I like to do typically is to wait for a correction and then again use my market geometry to figure out what correction I'm going or moving with, and in combination with Elliott wave, which is a completely different subject for another video. And then I'll try to identify what correction I'm working with or might be seeing on the chart, and then figure out where such a correction might end. Very cool. This was just an ABC, an A, B, C. And how would I know that? Because an A wave would start with 5 waves. Very clear to see in this one. 1, 2, 3, 4, 5. You've got a correction to the upside. We have a 1, 2, 3, 4, 5 down to the downside again. And if you would then connect it to your top of this correction where it started from, let me just label that for you quickly. Then you would have had an A, B, and a C wave. Now, very difficult to obviously figure out in real time what correction you might be working with, but this is again while I'm using market geometry. You would not find a correction that just works in 5 ways unless you're dealing with what we call an expanded flat, which is again another subject for a different video. But once you see 5 waves, always expect a counter trend move. In this case, a lower low, a lower high, and then once you'll go to correction, and after this will then be a single zigzag, as we call it. And this is a really good example where you've got a confluence of a longer term median line and a shorter term median line applied over a correction. And where there were confluence of both these lines is where a reversal started from. Now, let me just move into this a little bit more. You can see once price reached this lower warning or median line of this shift pitchfork, which is my go-to setting when I try or apply them over corrections. I probably use this 95%. There was a correction to the upside, a little one, and then down to the bottom side again. And this is where it's important to understand that you don't just trade on a whim. You always try to use multi-time frame analysis. I like something like the MACD, which shows momentum divergence into a low. So we got a low coming into this one here with strong momentum. You can even drill down to a smaller time frame, which I'm not going to do now. And as price goes up and moves down to the bottom, the momentum starts drying up again. Let me just open that up again. So on a 4-hour chart, I've actually looked at this. There would have been clear 2 peaks to the downside, with the first one quite strong and the second one not as strong, giving you momentum divergence with a confluence of 2 different median lines taken from different, or can I say from different lengths of operation. So that is pretty much how I define trends. Pitchforks work extremely well to define the probable future path that a trend might be moving in. Okay, so that one's done in hindsight. This is something I'm currently tracking, obviously, at the moment, is this movement that we had to the upside. I'm currently seeing this as sort of a 1, 2, whatever this was, most likely a third wave, an A, B, C to the downside, and now we're getting 5 waves. And let me just label that again for you. 1, this could have been a triangle. I'm just going to use that as a 2. Most likely a third wave, a 4th wave, and we might just be going into a 5th wave now. Obviously, there's more to this, guys, but loosely applied, and this is a good example of how I loosely apply Elliott wave. So that just gives me sort of a roadmap of what I'm going to do. What do you always expect after your 5 waves moves up in a bullish or a bearish sequence, depending on obviously direction you're trading? You can then expect a larger correction before your next move to the upside starts again. So that's my current view of what I'm thinking is happening on Euro US dollar. But like we said, I'm working with trends in this video today. Let's apply the same thing we did with that previous trend. Let's just go to our pitchfork again. We're going to go to this low, which started here in March on the 23rd. Go to that high over there and go to this higher low over here. And this again, guys, was a shift setting. Again, like I mentioned, my go-to setting. If I were to just switch to the original one, you can immediately see that price left the boundaries of this pitchfork. So it's very important that you try to slope a pitchfork at an angle that contains price really well. So there again, in this scenario, using this one, that one, and my third anchor point, we can already start seeing that price start respecting the median line here, low median line. And once you see this, you can quite often have a really good idea that price would continuously respect these lines to the upside. Again, price broke above the upper red warning line in this case, but what did it do? It couldn't break below it again. So what if I do, if I copy and paste this again and apply that to the upside? Let me just get that nice and right for you guys. Then boom. This is amazing to see how this happens over and over and over and again in markets. Price failed to get through the upper red warning line over there. Obviously, knowing not to trade this high, but rather this one, if you want to go short, I would say this was just a very strong bullish impulsive wave. This is why I'm saying this is a third wave. And even after that, look how cool price continuously respected these lines by simply selecting those 3 pivots from this origin point. And that, guys, is how I define trends. Try to figure out where support and resistance might come into a trend. But like I mentioned before, I apply Elliott wave loosely in this case. You'll have a lot of guys that's going to really break their heads about what are these counts in between. I'm more worried about seeing where price, sorry, wrong thing, copy and paste that. Just bear with me, sorry, Control C, Control V. Where price actually found support and resistance, and if you know anything about Elliott wave, your impulsive waves would be your third waves, your corrective waves would be your second and your fourth waves, and then your sequence would complete with 5 waves up and perhaps just breaking this high or even reaching this upper median line again. Okay guys, so hopefully that helped you guys out a little bit, especially the settings between the different pitchforks. I know a lot of people say, like I mentioned before, should we use standard pitchforks when defining a trend because they run at a steeper angle like trends tend to do. But I find in the majority of cases that if you use a shift pitchfork or even a modified pitchfork, that they contain price much better. And even though, like in this case, price moved above the boundaries of this original or shift pitchfork, you just copy and paste it above and apply it to the top side, and they will continue to work for a very, very, very long time. And then using, before I finish off here, Elliott wave very loosely to try to figure out where you are within a sequence of a bullish move or bearish move, depending on what direction you're trading. Okay guys, I hope you enjoyed this video, and I'll be back next time with another video. Until next time, have a great one. Thank you. Bye bye.